Welcome back to Making Money Matter and this week's Gold Room podcast with our guests today. Let me introduce you to each of them. I have Kurt Linghor. Just give us a little wave, Kurt. He's a private investor based in Melbourne, loves gold, and I often talk to Kurt about what he sees as the trends going forward. Next to him or underneath him is Sean Russo. He's the founder and managing director of Noah's Rule based in Sydney. And last but by no means least, we have Karina. She is a senior research analyst with Acorn Capital based in Melbourne. Karina really looks at the equity side of things. Obviously, Kurt's looking to make sure that he not only protects his purchasing power, but makes some along the way. And Sean understands what's going on with the prices. And it's a pretty crazy time because as I speak to all of you today, Friday the 11th, I think it is, the 12th, I'm sorry, of April, Friday the 12th of April, there's a rocket under the gold price. Sean, what's going on?
Look, I think something that obviously is really confusing a lot of people because gold is rising at a time where the things that a lot of people who think they understand gold, those things are not there. So dollar's not falling, gold shouldn't be going up. We have positive real rates, gold shouldn't be going up. There's all these kind of things that people are clinging on to. But having been in the gold market for 40 years, one of the things I know, there's long periods of time when no one paid any attention to real rates. You know, there's a lot of time when no one paid any attention to the dollar because gold was rising and so was the US dollar. So, you know, people kind of latch onto things. It's a bit like unemployment numbers are big until they're not, and then someone changes to something else. So right at the moment, you've had quite a period of time where gold was linked to real rates, and that broke down. So people go, oh, the gold market's broken or something's happening. And I've seen a lot of people either say, I don't understand this rally, therefore it can't continue, or this rally is sort of against the natural order of things. But the market is the truth. And so Jack Nicholson, you know, you can't handle the truth. It's like that. The market is where the market is. So whatever rules these other people are applying, the gold market is currently ignoring them, which says there's other people out there that have a different idea, and that's the idea that's currently being applied.
Yeah, and you said something earlier, Kurt, to me just off camera before we came on. That's exactly what you were talking about, weren't you?
Yeah, that's it. That's exactly right. I mean, interest rates, 10-year, 2-year bonds, they should be inversely correlated to the price of gold. But as of early March, they're moving in the same direction. So one of them's wrong. But to Sean's point, it is what it is. You know, we're not in the prediction business, we're in the positioning business.
And you can't use the word should. You can't use the word should because it's you know, like it's not necessarily right. They were for some time, but
something's changed. Like I'm kind of wondering now, is there a structural change? So I'm, you know, like they say, gold's one of these things that's lived in the ground millions and millions of years and only to be dug up and stuck underground again into the vault for another couple of million years. But, you know, at the end of the day, is there a structural change underway now with the sanctions and you know, this flight to a gold and untethering from the US dollar? So
yeah, it's a question that I think a lot of people are asking at the moment, and most people are scratching their heads. But I think, Sean, to your point, it is turning itself around. The gold price you're seeing, you do a lot of charting and a lot of looking at long term what the gold price is doing. What are you seeing?
Well, the thing that we're overwhelmingly have seen since 2018, really, 2019, is that gold has been outperforming bonds. So you'd be better off to own gold that doesn't pay a yield. Everyone likes to criticize gold because it doesn't pay a yield. And they say, just dig it out of the ground and put it back in a hole in the ground, right? Yeah. But Warren Buffett likes to say that, and everyone likes to quote Warren. But in this case, he's wrong. The second thing, so it's outperforming bonds. So every bond person, right, because we had a 40-year bear market where interest rates were falling, you know, bear market in yields, bull market in bonds. It was just easy to buy bonds, interest rates go down, you make money. All of a sudden, 2018, that breaks down. When gold is outperforming bonds, that tells people that gold sniffs inflation. Don't care what Jay Powell says, look at what's happening in the market. Again, you know, the truth. So the truth is that gold's been outperforming bonds since 2018. I think at about 2020, it broke the previous high of that trend where gold had been outperforming until 11-12. So we went through the 11-12 highs. So and it's just made new highs. So gold's outperforming bonds. So every bond manager in the world is going, it's really hard to make money in bonds. Maybe I should add gold to my portfolio. At the same time, since 2018, gold has been matching equities. Now, you will not read anywhere in any general media that gold has done as well as being long the Dow, right? I mean, no one's going to, or the All Ords, no one's going to tell you that. But that's the case. Gold's been doing just as well. It's been matching equities. But in recent times, it's been starting to outperform equities. So like the bond people who go, don't understand it, but I've got to maybe look at buying some gold because it's outperforming bonds. General equity investors, are looking at this and going, if gold starts to outperform general equities, I need to own some. And we've not been seeing that in the ETF, like it's been falling, but some smart people out there have been sniffing out again, this inflation's coming back or whatever. But if we find ourselves, as we probably will this week, now seeing gold has been outperforming general equities for a while now and is outperforming bonds, the amount of money over in that market, not very much of it has to come across to gold. And gold is a global market, but it's tiny. I mean, it turns over a lot every day, but it's such a small market. Yeah. A few new people all want to get long gold. The market moves a long way in a short period of time.
That brings me nicely to you, Karina, because you're very much, as I said earlier in my introduction to you, you're a senior research analyst with Acorn Capital. You're looking at equities. And you and I have spoken about this before. There appears to be, especially in the small cap market, a disconnect with the price of gold, the excitement around that physical gold, and equities. Is that changing, or is it still on the nose?
I mean, I think it's fair to say at some point you would expect it to revert. You can't expect that the equities would be lower valued over a longer period of time when the commodity that they're mining continues to go up. Yeah. What has been happening for the gold producers over the last 12, 18 months is clearly they've been impacted by inflation. So whilst that gold price has gone up for them, so have their costs. So their margin has actually not expanded in that time frame. So the question then becomes, looking forward, do we see that changing? And certainly my intelligence talking to companies every day is that we are starting to see that inflation soften. I'm not going to say it's deflationary, but we're definitely seeing the pressure come off. Not only is it the energy cost declining over time, because clearly when Russia invaded Ukraine, we had a massive increase in energy prices back in 2022, and that had a very long period where it kept impacting the inflation. We've also had labour costs tightness in certain markets, particularly in Western Australia. So the Australian gold producers have generally benefited when the US gold has gone up and the Aussie dollar has fallen. But in reality, on the equities markets, they haven't really been rewarded in the last 12 or 18 months. But we are now starting to hear that labour pressure is coming off. We've had a number of mines shut down in the nickel market. We're hearing about redundancies in the iron ore space. That then relieves a lot of that technical skills shortage that we're seeing. So it's not just necessarily about the cost of those skills. It means the skill base of those specialist people. You're now able to get an experienced person perhaps for the same price that 2 years ago you were having to get an inexperienced person, which means when they do come on board, they're productive from the first couple of weeks as opposed to having to train them up and they're not productive until 6 months later. So you're getting that efficiency, productivity gain, lack of inflation going forward or minimal inflation going forward, and the gold price rising. I would expect over the next 12 months you will see those gold equities respond if you're a producer. But what we have also spoken about, Kerry, is if you're a junior explorer or a developer, you have been smashed in the last 18 months, and we've seen massive dislocation between the producers and the developers and explorers, and that is still the case today. And certainly at Acorn Capital, we believe that that will revert in due course. We can't predict when, but we feel like we're now 22 to 23 months into a bear market in the microcap space. There's been 9 microcap bear markets since the 70s, and the longest one was 23 months. So this 9th bear market, we're 23 months into. So we feel that at some point in due course, in the next 12 months, you would expect that that will change. What the catalyst will be, I think it will be a lot of people have spoken about interest rates. We're bottom-up investors. We're always looking for opportunities of good quality assets in good jurisdictions with good management. And there are certainly now, you've started to see a lot of the poor quality companies have fallen in value and they've stayed fallen, whereas good quality assets might have fallen back in January, but they've now rebounded post-January as the market's starting to really recognise quality over a lack of quality assets.
Karina, a quick question, if I may. Sorry,
go for
it. Are you picking up a sense in the market that people don't believe this rally will be sustained? Is that why there's perhaps a bit of a lag in the equities there? They're expecting the gold to come off?
I think that we now have a market which says they'll believe it when they see it. So until you see the March quarterlies come out, and as I said, I'm not sure that the inflation picture or the lack of more inflation is going to be as visible in the March quarter, but I definitely think we'll start to see it in the June quarterly. You've had a few producers being impacted by rain in February and March, like Gold Road or like Capricorn, and that obviously is impacting their production rates, so their costs won't actually fall this quarter necessarily. You're seeing some behaviour as related to weather as opposed to inflation per se. So I do think we'll start to see that more in the June quarter. So to answer your question, Kurt, I think investors are waiting to see it in real life. They're not front running it.
And
I have this. Sorry, Sean.
I was just saying,
I have this image in my head that Wayland Smithers and Homer Simpson in the nuclear power plant, all the dials are turned up to 11 as they're cranking these machines out. But faster.
I'm going to come to you in a second, but Sean, what did you want to say?
Well, I was just say that the commentary, I mean, the commentary is clear that people don't believe this, going back to my thing at the beginning, that people just going, well, it's not demand from this and it's not central banks. Like one of the best commentators I know said, well, it's not central banks because the buying's not on the fix. It's not in India and China because the premium isn't necessarily, aren't showing. The ETF volumes are coming off. Now, this thing with the ETFs is interesting. The ETFs didn't exist until the early 2000s, but because they rose while the price was rising in 2000, everyone said that's the meter, and it did top out at the same time. So now the ETF's been falling, gold's been going up. Oh, well, gold's broken. No, the ETF just shows you that people have a better thing to do than gold. I think one of the things I try and talk a lot about to investors and to our clients, gold investors I meet at conferences and our clients, is if gold is not performing well, it doesn't necessarily mean that people don't believe in gold. It's just if you spend all your time in gold, you go, gold should be going up, it's undervalued, right? For a long time, we've been saying gold's undervalued. Now, all of a sudden, it goes up and we all think it's overvalued. But people have other things that they're doing with their money that are more interesting.
Yeah.
And they don't come to gold until those other things are less interesting. And it's been too easy to make money being long in NVIDIA and whatever for a long time that they go, yeah, I see gold over there, but I think Kurt says, I have to sell one of my darling stocks that I own to buy another one. I have to break up with one of the stocks I love to buy another one.
I'm going to get that. And I do want to come to Kurt on that one.
And so that's the thing. So these people are going, well, yeah, I see gold improving, but until it's doing better than NVIDIA, and if I'm a generalist investor, if I lose money in gold, I get beaten up. If I lose money in NVIDIA, everyone goes, oh, well, who knew that was finally going to end? Like you don't stray out of your patch. So you've got to break up with the things that you love. We're about to break up, I think, with the Dow. Generalist investors are starting to go, this is way out over its skis. Yep. And I think that's what gold's telling me. And Dow gold goes below 16. And, you're going to see a big rush, I think, of generalist investors into gold.
Speaking of generalist investors, that's you, Kurt. I know
anything
like
but
gold.
Generalist.
What's that?
Anything but generalist.
Kurt, what are you seeing as a private investor, as somebody that's sort of looking at where you can? I always say, rule number one: don't lose money. You got to keep your money, and you got to make money. Well, are you loving gold at the moment, or are you just doing what Karina talked about with gold?
Well, I am, but for different reasons, I suppose. In that, you think back a couple of years, the pandemonium was around lithium in Australia.
Yeah.
It was hot. Then we ran into rare earths. That was hot. Then we all jumped into James Bay, lithium in Quebec. And then we jumped on AI, and now it's gold's turn. So one of the habits I try and remind myself daily is I'm not in the prediction business, I'm in the positioning business. So if gold's running right now, I'm not going to stand in front of it, just like I wouldn't stand in front of Nvidia. You know, it's running and it's running, it's running. It'll turn at some point, but who knows where that is.
So what would you say to people that are listening, that are looking at this, Kurt, that are not professional investors, if you like? What would you say to them right now? Because it's all about being sensible and not getting hysterical about what you're doing and how you're getting into this market.
Buy look at quality companies, all right? So that's number one is, well, let me go back a step. There's a great book called What I Learned Losing $1 Million.
Oh, I like that.
And that's a great book. That's a really great read. Anyway, you'll get many things out of that. But one of the things that I got out of that was rule number one is, what kind of participant do you want to be? So if you're looking at this gold and you're looking at it from a FOMO trade, you know, it's like, well, what kind of participant do you want to be? Do you run a jewelry store? Do you run a central bank? Are you a speculator? Are you riding it from 2,400 up to 2,800? Are you looking at dividends? Are you looking at income producers? Are you looking for exploration leverage? So it really comes back to number one is, what kind of participant do you want to be in this market?
Yeah.
And what's your appetite for risk?
Yeah, I think that's really important too. And speaking of which, I just want to do a quick break and let you all know, all of you that are listening, the Australian Gold Conference is going to be on at Crown Towers in Sydney. You want to talk to these people face to face? They'll be at the Australian Gold Conference 26th to the 28th of August. You can go to goldevents.com.au, book your tickets. It's going to be a cracker this year. But moving on,
buy early, buy often.
Is that your advice to people?
For the tickets to the conference.
But for the tickets.
Yeah, they're going to sell out.
I actually think we will this year, because we can only fit a certain number of people at the event. And I know, Sean, you're going to be speaking at the conference. You do a lot of charting and a lot of looking at this. Do you think we're just getting started?
I think yes. I mean, I said 2 years ago at your conference, and again last year, Kerry, that sell anything that you own today and buy gold, and I think you'll be able to buy more of that same thing back.
Yeah,
in the future.
exactly what you said.
You know, and that's proving to be very much the case, right? Gold is going up faster than most other things, particularly in this last little while. So it's playing catch up, you could argue, but it's certainly there. So, you know, we looked yesterday with our clients about, you know, people say, oh, the gold's a bit overdone at the moment. Yesterday, I think US dollar gold is about 25% above its 200-week moving average, and Aussie dollar gold is about 32% above. In the last bull market from 2000 to 2012, gold quite regularly got to 60 to 70% above its 200-week moving average. Even in 2020, we were 50% above the 200-week moving average. What's happened is the 200-week moving average has moved up from 1,800, it moved up quite substantially, from 1,400 to 1,800. So that allows the market to go further before any of the algorithmic things kind of go, oh, this has just gone too far, let's sell it and see if we can turn the hot money around. So by that measure, we're not too far. We did in our conversation with clients yesterday note that the $8 gold price is far more out over its skis than the US dollar gold price. I mean, the number of ounces it would take to buy one of every share in the All Ords is the same today as in 2011, 2012, in Australia. So whereas in the US, you can buy 3 times as many ounces of gold if you sold the Dow. So the US stock, that's how much more the US stock market's outperformed gold relative to the $8 stock market. So the $8 market has not outperformed gold since 2012, the All Ords. Whereas the US market's outperformed by a factor of 3. So it's much easier to see why a US investor would sell some shares and buy gold if they're US dollar based. In Australia, that's a bit harder, because there's gold's run a long way, and really what that's reflecting is the weakness of the Australian dollar. And that's the big thing that you have to think about if you're an Australian investor, that you're going short Aussie if you buy gold, And so that's a, when Aussie's down here, that's a bit of a challenge. We did see in the early 2000s, US dollar gold went up 75%. Aussie dollar gold was unchanged over that period, over 5 years, because the $8 went up just as fast. So
we are running out of time, so I'm going to have to just wrap this.
So that's the challenge for Australian investors, I think. Yeah. But overall, we think it's still just getting started. It's not overdone.
It's not overdone. Not overdone. Karina, are you getting set for this? What do you see that? Are you picking up some of the things that people are not looking at the moment?
Yeah, like I said, I think the shakeout in the junior part of the market has allowed the quality stocks to really be noticeable. Yep. I mean, as you know, there are so many stocks at the small end of the market. It's hard to know what to focus on, but I really think it's been so down for 18 months for the junior explorers that the really good quality companies are now really clear to the investor. So now is a good time to go and have a look at all those different junior quality stocks. In terms of the producers, you are seeing consolidation. You've seen that Perseus has taken over OreCorp. You've seen West Gold is now merging with Karora. Prior to that, there was potentially Ramelius merging with Karora, but it's turned out West Gold offered a better deal. You're seeing Red 5 being merged with Silver Lake. So you are seeing those mid-tier gold producers consolidating, and the reason they're obviously looking to consolidate is synergy, high costs, lower margins. By merging, you're going to be able to rip out a lot of head office costs. You're going to have a lot more, when it's difficult to get skills, you've got a lot more operational latency now, so you'll be able to move particular skill sets from one mine to another, whereas when you're a single asset, single producer, you have to own the whole skill set. But when you're a multi-mine company, you can have a team that you mobilize around for particular purposes. It makes you more efficient. So I think we're definitely going to see efficiency in the producers going forward as this consolidation happens, and you'll start to see that turn into cash flow in coming quarters. But the juniors are very unloved, and they have not had any love for 18 months. And really what's happened is you've had no one turn into the developer space because the juniors haven't been able to raise enough money to get their projects to a point where they can go through a PFS or go through a DFS because they haven't been able to raise the funds to progress. So you've now got these resources, and you're seeing the larger companies have bought in. Obviously, OreCorp got taken. You've seen Ramelius make a number of acquisitions, and you know full well there's a lot of the other producers are still looking for acquisitions. So there's a good chance if you have a good quality resource in a good location, it's going to get taken out because it's a lot cheaper to buy those resources than drill them out and look for them yourself now.
Really good information there. Kurt, what makes you look at a company? Is it management? Is it the asset itself? As an investor, what are you looking at?
I'm looking at line of sight. Can they make money? And a great team. That's why it's so important to get along to great conferences like the Gold Conference, Kerry.
Oh, well said. He gets the gold star.
Over people. But seriously, a great team, a great project, and will it be economically viable? And where are they on the cost curve? That's the other thing.
Do you, Kurt, as an investor, do you read the quarterlies? Do you do your research? Because I think that's one of the things that I'm always saying to people: don't get your information from social media, get it from Making Money Matter. But you got to do your work, haven't you?
Yeah, absolutely. You have to do your work. You've got to read the fine print. Always look at the fine print. I've studied charts like De Grey and Dreadnought and
Dreadnought will be both of those will be at the Gold Conference, so we can.
You look at those charts; they go parabolic, and you go, "Well, what did I miss in their quarterly reports? What did I miss? What was in there?" Like Azure, another one. I had that same conversation with Tony recently. Like, what did I miss in your reporting? But then you go to the conferences, and then you can triangulate the companies as well. You can play them off against each other. Like, why are you better than them? Oh, they don't have a mill, or they've got their gold is refractory. They're the questions that you get to ask by going to these conferences. But then again, you hang around with these awesome individuals here as well. So you get to sort of share their knowledge and sort of talk to them as well. So yeah.
Thank you very much. We're going to have to wrap it up, but I want to wrap it up before I go and we finish up this week's program. Hong Kong has just seized over $10 million worth of gold disguised as machine parts in a record smuggling bust. That's 146 kilos of gold, which was worth more than 10 million. They were on a plane headed to Japan, disguised as parts of a couple of air compressors. So big gold smuggling cases. So clearly this is one of Hong Kong's largest busts, or gold smuggling busts. where they got it and they'd been concealed as machine parts. And I think this is quite amusing. The machine parts, I think, were to go to mining parts, I guess. So illicit gold, guys. Final comments to you. What do you reckon? More of that going to happen? Bit of fun as we wrap it up.
Gold.
Yeah, I think, sorry, no. Yeah, I think that what we've spoken about today is this inherent uncertainty that's happening out globally. I mean, between the multiple wars that we're currently now facing, the majority of the world is going to democratic or not democratic elections this year. So there's a huge amount of uncertainty, broadly speaking. And so physical assets are clearly being more highly prized given the uncertainties that are out there today.
And we are always being ingenious about the way we do it. Sean, go on.
People in the West put far too much trust in central banks. And people in the West are selling gold at the moment because they think everything's fine and they believe it's all going to be okay. People in the East have always bought gold and they're buying more now. And like in India, they're buying silver in record numbers, and they're buying silver because the gold-silver ratio is so high, it's better to buy silver than to buy gold for them in value. But they're buying it to get rid of paper money.
Yeah.
But they only carry enough paper money to buy the next thing they need. And even then they can always buy with silver if they need. People will understand the value in silver. So it's about trying to get out of paper money because they see the system is broken.
Yep.
And they believe that everyone's going to go into competitive currency devaluations. The Chinese are scared stiff that the Chinese are going to devalue the RMB because the yen is so weak. And there's a school of thought that the Americans are allowing the Japanese to keep the yen weak to keep the pressure on China. So if people think that paper, like currencies are going to devalue, it's actually gold's not going up. The value of money is falling.
And that's a great way to finish it up. Sorry, Kurt, I'm going to have to wrap it all up.
Sorry, Kurt.
Your paper currency is going down, down, down. Come along to the Australian Gold Conference. I'm telling you, even if you don't want to come for the whole 3 days, turn up on Monday. We're going to teach each and every one of you that have no idea about how to even get started in gold. We're going to show you all the different ways. There is no hard sell. Come along to Crown. It is free to attend on the Monday evening. We're going to have a bit of fun, but we're also going to help you out there understand why gold should be an important part of your portfolio. But as always, this is not investment advice, but thanks for joining us today. Thanks to all my guests as well. We'll see you next time.
Thanks, Kerry. Thanks, guys.
Kerry.
Thanks, guys. Bye.